Hello everyone, I'm Rob Young, founder of Blue Dot Wealth Management. And welcome to 2024. This is part 2 of our market outlook, so welcome back. To recap, as we move into the new year, there seem to be clouds on the horizon. Every so often, the sun peeks out and the markets rally, only for the clouds to roll in again. Is it going to rain? Are we going to have a recession? Or will the sun come out and lead to a soft landing? In our last video, we talked about inflation and the Fed. In this video, we're going to talk about the markets and the 2024 election. So let's dive in. I like to think about catalysts for growth. What will allow people to be more creative or productive, or what trends or experiences will people spend money on? Looking at 2024, there seems to be no clear catalyst that will lead to sustained long-term growth. This may be a year that we all collectively catch our breath and wait. Stock valuations are a little elevated, but with the recent pullback in the 10-year Treasury, we feel the index is fairly valued, though some individual companies are certainly not. Household debt is rising. More on that in a little bit. The promise of artificial intelligence is likely to help increase productivity and reduce costs at some point. But while the speed of adaptation of that technology may increase, how it will translate into earnings and profits is not clear. Nor will a cut in interest rates be the shot in the arm that most are hoping for. Oftentimes, when analysts make assumptions about returns, they bake in rate cuts or rises into their price targets. If the Fed cuts rates 3 times, we shouldn't expect higher equity returns to follow. The market has been pulled higher most of 2023 by the Magnificent Seven: Apple, Google, Amazon, Meta, Facebook, Nvidia, and Tesla. But that doesn't seem sustainable, and the valuations of those companies are much higher than the average stock in the S&P 500. A pullback in 2 or 3 of these names would need to be counterbalanced by dozens of other S&P 500 companies. To illustrate the impact these companies have had on the index, the equal-weighted S&P 500 was up about 12%. The S&P 500 index, which is market cap weighted, returned around 26%. Over the last 20 years, the average performance between equal weighted and market cap weighted have been pretty close. Seeing this large of a divergence is a data point, one we are paying attention to. Let's look at the positives though. Since November, most market indexes have rallied and are at or near their 2021 peak. Lower valued companies are moving in a positive direction due to positive earnings surprises. From November through early January, we've seen roughly 20% of S&P companies hit a new 52-week high, something that was lacking for most of 2023. Despite feelings of pessimism among households, savings and home equity is still high. According to Bank of America's research team, household savings is growing at 8.5%. It's the highest level in 30 years. And the corporate sector's balance sheets look stronger as well. Corporate cash is nearly $7 trillion. And while that number is not at an all-time high, it does mean that many companies have excess reserves. It also means that they are absorbing higher costs like payroll and material expenses. One more positive thing to think about, something that you've heard me say for all of 2022 and all of 2023, there is a difference between survey data and behavior. People have said for 2 years straight that they are pessimistic about the economy and the market. Their behavior, however, has said otherwise. Household spending has been a big surprise to Wall Street forecasters, and they have largely gotten it wrong. If there is one thing that seems like they agree on this year, it is a consumer-led slowdown. Is a third time's a charm the right outlook? Again, as we alluded to this in part 1, if unemployment remains low, we believe the consumer will continue to spend. Last, adding to the threat of rain is the fact that 2024 is an election year. Wall Street will be looking for some indication of which way the political winds will blow. The media will remind you that the markets hate uncertainty, and there will be plenty of scary headlines and political ads to influence your decision making. Here's a chart of the returns over the last 96 years during an election year. In other words, the last 24 elections. The average return in an election year is about 7.5%, and 75% of the years have been a positive return for the stock market. Of course, what we should all hate about averages is that they are just that, an average. Only 20% of the elections are within a 3% plus or minus of that average. As you can see, there is a much wider distribution of possibilities, most of which, again, are positive. What this should tell you is an election is all noise, not signal. What does all this mean for the stock market in 2024? The short answer is, we don't know. Headwinds or tailwinds are all dependent on expectations, not data. To use an often overused market-related phrase, Wall Street loves a wall of worry, and there is plenty to worry about. Our expectation is that the breadth of the rally that we've seen in 2023 broadens modestly and slowly, but we continue to be very interested in consumer and inflation data as it comes in. In other words, there's about a 75% chance of sun, and while you might not need your umbrella, it's a good idea to pack it. Thank you very much.